Hi, Gary and Kevin here. This is our second quarter market observer. And the quarter started off with wondering what was happening out of the polar vortex. We had a minus 2.9% GDP for the first quarter, and there was a lot of concern. And the second quarter GDP numbers came in at 4%. So it looked like things were going along fine. It bounced back and so forth. We also have had an average of 215,000 new jobs per month. We haven't seen that kind of rate back to 2005 and 1999. So job growth is really coming along. And with that, we finally, after 6 years, replaced all the jobs that were lost at the beginning of this crisis. Lastly, the Federal Reserve meets annually in Jackson Hole. Just happened a week ago. And Janet Yellen started to discuss what was going on with raising interest rates. Well, she had so many ways of mixing the message, and no one really knew what she said. So she's playing her cards very close to the vest, and no one really knows what it's going to mean. However, the market thinks it's going to happen in June of 2015. But what we do know, and she's been very, very clear about, is that the quantitative easing number 3 is going to go away by October. We're now at $25 billion that they're buying every month in bonds, and that go to zero. So my question to you, Kevin, is what does that mean for the economy and the markets going forward?
Well, I double majored in economics, so I can give you a multifaceted answer as well. What's it, Peter Lynch's old line? If you study 10 minutes on economics, you spend 5 minutes too many. You look at the market's history so far this year. I mean, up 3%, down 8 or 9, up 4%, up down 4. I mean, January through now has had 4 or 5 spikes up and down. A lot of that might be the hot trading money, trying to find a place to go. People, hedge funds, whatever, trying to determine which way things are going to go. Individual investors seem to be getting out, like high yield bonds declined, then they're coming back. So it's kind of like the economy. It's a slow growth, signs that things are getting better. Trying to predict just what the next step, if they truly scale back and finish the tapering. I mean, what happened after they discontinued QE1 and QE2?
Oh, they had to come back and do it again?
The markets fell off. May of last year, when they had the Bernanke's comments where planting the seed, if you will, that the tapering was going to be out on the horizon, and the bond market got hit pretty good. Well, bonds are up.
Yeah.
Yields are at all-time lows. Our 10-year Treasury is lower than the 10-year Treasury in Spain. So I think all things being equal, you look at the uncertainty of how the Fed's going to handle unwinding its balance sheet. $4 trillion of bond purchases. Are they going to take that money out of the system? It's not inflationary to date. You're still seeing tepid signs of improvement.
Right.
Now, maybe very well, we see housing continue to improve, employment at lows
6%,
post crisis. You're seeing uptick in growth. You're, like you said, uptick in employment. Moderately cautious.
Right. Yeah.
Do we see a recession, which is ultimately what people would worry about for a stock market decline? Not really.
No.
So I think your core positions being held and keeping it close to the vest with bonds, with rates being so low, because there's no way but up.
Yeah, exactly. So the other thing that we observed is they have this mid-year Barron's Roundtable where a bunch of these guys get together and talk about the markets and the economy. And one of them is Bill Gross, and he tends to be a little bearish, or has been recently. And he's talked about this artificially created price earnings in the economy. But he said something interesting. He said he thought when the party's over, and the party right now is U.S. buying bonds, Japan's even doing more check writing than we are, and the European stimulus of $500 billion is going to start next month. It's going to start in September. So he thinks the party's going to end with just kind of a momentum fading away, not a big bubble burst. So this whole artificial
It's rather positive
earnings,
for him,
Well, yeah, on the bond side, of course.
Yeah.
So what does that have to do with?
Yeah, that's maybe what you look at the market's performance again year to date. I mean, it's trying to find its traction of where things are going, but it hasn't been a drastic move, and we haven't had a 10% correction in the last
over 2.5 years.
Yeah, 2.5 years. So one of the longest bull runs that we've had. Of course, coming off significant lows. Earnings continuing to increase now above where they were. Market not necessarily overvalued unless you believe, some of the people out there, the value people, that inflation adjusting earnings are too high. They're at peak profitability. It's not sustainable.
All right.
Maybe none of that's taken into account. What's going on and what's seeing signs of the economy in terms of the manufacturing sector, the competitiveness relatively of our country,
Right.
The growing demand in the emerging economies, which is now half the world's gross domestic product.
Mm-hmm.
Who's to say that the next 5 to 10 years we don't see some of these things like the energy sector
Right.
and a pickup in activity in this country? We've been delevering.
Right.
The last 30 years we were spending more than we were making. Maybe going forward, the tides turn, which would be bullish, and ultimately, maybe an opportunity for them to release that money from the balance sheet that they've been tapering, or after the taper expires.
And we were looking at, Kevin and I were looking at this chart just today, and it showed the price earnings, forward earnings on the S&P 500, the mid caps, and the small, and it looks somewhat right middle of the road.
The $64,000 question is just what sustainable earnings are, and are they peak earnings,
Right.
and are they necessarily going to be a big decline? $100 back in the when 08 hit, back above that now, and projected to be $130 in the next
Right.
12 months. The case to be made that it's not sustainable because it is fueled by quantitative easing and Fed injecting money into the system.
Right.
The other side of the equation which is what Bill Gross may be saying, is that the economy may very well to carry the load going forward.
Right. So it's interesting. We come full circle. You come from the Fed and come back around to looking at what earnings are taking place and real growth is happening and jobs are being created. And so you don't know which, it's the chicken or the egg, right? What's come first or not. But, so the next time we're going to catch up with you would be, believe it or not, when the snow flies here in December.
When you were talking about polar vortex a second ago, it's like how fast we forget.
It's coming up again. So have a great fall, and we'll see you next time.
Thank you.